So this is the Dealmakers panel. Those of us up here, and I'm sure you all are all involved in deals. It's what we do. It's the lifeblood of the industry, whether that's licensing, M&A, and indeed fundraising, all transactional, all part of pushing this industry forward. And we live through the ups and downs of it. At PharmaVentures, we've been going 30 years, so we've seen both the good times and the bad times, and we're still here. So lots to talk about. First of all, I'd like to ask the panelists to just introduce themselves to you, who they are, who they're representing, and also maybe a comment on whether throughout their careers they're a buy side or sell side or both, so we know which side of the table they've sat on, and how that will be colouring their comments today. Duncan, do you want to go first?
Thanks, Adrian, and good morning, everyone. So I'm Duncan Young, Head of Business Development at Redx Pharma. Redx is a small molecule-focused biotech company in the UK in the areas of oncology and fibrosis. We've got a program in phase 2 for oncology and phase 2 for fibrosis, and a small molecule pipeline behind that. I joined Redx Pharma 4 months ago. And prior to that, I was working at AstraZeneca in the oncology search and evaluation business development team. So I was in, I guess, on the buy side for 7-8 years, and now trying it on the sell side, and have my first JP Morgan, actually having to run between the hotels rather than pitch up a tent in one. So I'm getting to experience it the other side of the table.
Also on the buy side, you kind of run between hotels, but that's just a side comment, yeah. So yeah, welcome also from my end. My name is Matthias Müllenbeck. I'm heading Global Business Development and Alliance Management for the healthcare division of Merck KGaA. I've been with Merck for 10 years and really since then, yeah, on the buy side. Really great to be here.
Good morning, Paul Hermant. I'm a corporate and commercial partner at Bird & Bird, based in Brussels, but I'm leading the global corporate life science group. As most of you probably know, Bird & Bird is one of the top, or perhaps even sometimes the top law firm in life science, work in all its dimensions in Europe and in Asia. And I'm very happy to be here to share our experience of the legal and contractual aspects of deal making.
Hi, and I'm Zaki Salanti. I'm heading search and evaluation at Novo Nordisk. So that would be buyer side. Novo is notoriously known for its diabetes and obesity, but we are trying to expand and grow into cardiovascular, kidney, liver, and other adjacencies to the diabetic disease.
I realized I forgot to answer your answer about the sides. I'm on all sides, but only once at each moment.
Perfect. Thanks everybody. Okay, so as chair, I get the benefit of being able to show a few slides and say a few things to set context. So hence the large purple screen behind me. And if I can operate the technology, we'll do that. So I'm guessing most of you have heard of PharmaVentures. We've been around a long time. We're a corporate advisory firm. We're deal advisors, licensing, M&A, and we do a little bit of fundraising as well. Typically, we operate more on the sell side, and we operate more for smaller biotechs looking to do something with the bigger guys, whether that's raise money or actually cut a deal. That said, we do work for the big guys as well, usually more on the buy side when they're looking for something special. So, I've been told I have to point this there, otherwise it doesn't work. There we go. So I now have to turn around because I don't know what I'm looking at. Actually, it might be better if I stand. Should I stand up? So we've got full year data here. And what I thought, I did pick 5 years because it gives us that pre-COVID, the period from 2020 to 2022, the COVID period, and then the post-COVID war, Ukraine, Russia, and macroeconomic impact. It's a truism to say that in terms of both numbers and value, license deals and M&A deals have upward trended right from the very beginning in the early 80s when people first started doing deals, and there's been a constant upward trend. There have been dips, and the last one was around 2012 when we saw the big economic crash, but things have still risen since then. So we're looking at a little bit of a downtrend here at the moment in terms of licensing deals, and this data is all companies, all deals. And what you can see there on the numbers is, on the blue line and the yellow highlighted are the actual number of deals that year. The purple is the total projected deal value, so that's upfronts and milestones, royalties not included. And the orange is the average upfront payment across those deals. So it's all therapeutic areas, all deals, all types of companies. And what we see there is reaching a sort of peak in 2021, 2020 to 2021 of 1,300, 1,400 deals, and then a decline in 22 and a further decline 22 to 23 this year. During that 21 period, people were saying, what's happening in COVID? How's COVID going to impact? And we looked at all the data and said, we don't think it is right now. Everything's going as strong as it ever was. Of course, nobody expected the Ukraine situation to arise. And we thought it would carry on virtually as normal. Pharma still had pipelines to fill, and innovation was still coming, lots of VC money going, as we heard in some of the panels yesterday, and a little bit of data on that later. So we weren't anticipating things to turn the way they did. But clearly they have, and there's been a downturn. Upfront values have been maintained last year. We're looking at 40 million, the average upfront value, and total deal value still rising generally. A little bit of a drop in 2021-22. So in terms of values, the values are still maintaining, rising, the numbers are going down. If we just look at big pharma, and I mean big pharma, this is sort of large cap pharma, and the same data, you see a very similar picture. Although pharma held its own during the COVID period, they didn't seem to be fazed by that. So the 2021 to 22 period, there was only a slight drop in the total numbers. Total deal values maintained. Upfronts very similar, slightly dropping in the sort of COVID period, but back up to normal in the last year. So although deal numbers have dropped, we're down to nearly 500 from 700 and something, so a significant drop in deal numbers. Actually, total deal values have gone up. So paying more, less deals in the current environment. But remember, it's total, these are all contingent. The upfronts are about the same as what they ever were. That was licensing. We look at M&A. So here's the 5-year trends again over the same period, February to February, all companies, and you see M&A would remain strong up until February 2022. Numbers were rising as they ever did. Values sort of holding up. They were dropping somewhat in terms of total, people paying less. But the IPO window was open, people were IPOing, there was alternative ways of actually exiting and people getting money out. Come to the last 12 months, and we've seen things drop back to 2018-19 levels. We now only saw 470 M&A deals. Again, values increasing though. They're still at the same level, but they've increased from 2019, 2020, 2021. So values going up, numbers going down. The orange bars are the upfront. There's always some, in a lot of deals, there's a contingent element in it, and that's just reflected in that. But obviously, there's not the big gap that you see with upfronts and licensing deals. So again, look at big pharma trends. Again, they have gone down significantly. They went down last year, and they went down the year before. So whilst the licensing arena held up during COVID, when we got to 2020, it kind of tailed off a bit. Now, was that IPOs were easier, people could get out easier that way, farmers stopped buying things, big things, were there other factors, and the panel will reflect on that. The last 12 months, we're again down to 2018-29 levels of M&A, and the values have gone down. The average total value in 2018-19 was 5.7 billion. We're at 3.5 billion. This is very superficial data, and you always have to dig down and to understand what's really behind it, because you can get one big mega deal in one particular year can bump numbers up and down and make things look so. Whilst we're showing interesting things here, you really need to get under the data and see more. And I just slipped an extra slide in here, which I didn't tell the panel about, so they may want to turn around. I do this. Just because the comments came up, I think it was in the investor panel, I think Wilder's panel yesterday. We talked about the amount of money being raised. and what the investors do. And they're an important piece of this because obviously they are the instigators of a lot of what ultimately leads to a licensing, an M&A, or some other exit transaction. So this is the number of investments over time, going up to 2022 at the end there, right from 2013. And you see again the continued rise in a number of investments VCs were making over that time period, dropping in 2022. So there was certainly a drop there. And then the second graph is how much they were investing. And I think, Wilder, as you said, 2021 was a record year, 2020 and 2021 was a record year. 2022, there was a drop, but it only dropped down to 2020 levels. So still a huge amount of money in VC's hands, if you were, or being deployed, and still a large number of deals being done. But it did drop off. And obviously, concomitant was with around now we see the IPO window closing out as well. So there was an expectation that the IPO axis would cause an upswing in M&A activity. And there was an expectation that would happen back end of last year, beginning of this year. From the data we showed there, that we didn't see. We heard a few comments, I think it was in the Wall Street Journal a few weeks ago, about Novartis and I think it was Merck, maybe Merck, J&J, one other said, we've got billions, we're going out to spend it. We're going to go and do some M&A. We need to acquire things. It hasn't happened yet. So is that the kickstart we need? Well, we'll see. So let's kick this off then, and we should start with the impact of the macroeconomics. What's going on? We've seen there's a bit of data there. I was going to say Ryan, but he's not here. Ryan dropped out. We were going to have Ryan from BioNTech here, and which would have been great, but he's not here, so we're not going to have Ryan, so we can say what we like about BioNTech. Okay, Matthias, let's start with you on the macroeconomics. Right. You're a big pharma. There was some evidence there that big pharma aren't doing as much as they were, although they were during the COVID period. Are people standing still? What's going on?
Yeah. Maybe first of all, we characterize ourselves as a large biotech organization with the luxury to leverage a balance sheet of a big pharma. If you're aware of the construct that we have at Merck KGaA is really 3 business sectors, and healthcare is one of them. Maybe before I answer the macroeconomic question, I want to spend 1 minute actually to give you a glance of what our inorganic investment strategy is, because I think it will make very tangible what we're talking about later. Yeah? So we follow literally 2 verticals. One, very easy to remember, is called #25by25. So we want to raise the top line of the company by 2025 to 25 billion. It comes, I think, very natural that along that axis, on the inorganic piece, we focus really on late-stage asset, as de-risked as possible, as well as, let's call it, global or regional commercial partnerships. That's one area. The second area, also relatively easy to remember, #Mission 50%+. We were talking about this to the investor community since last September. So here we have the aim to increase the percentage of externally sourced assets within our pipeline to 50%+. So it also comes, I think, naturally that this is rather pre-POC, late-stage preclinical pre-POC opportunities. And maybe when we come to the next comments, company strategies, of course, differ, but I think the theme is always the same that you see at the moment. I think there are very little pharma companies that take very large bets for non-commercial opportunities. They are willing to plug and play in revenue. Think about the rumors that are currently on the street. Pfizer potentially now trying to take over Seagen, right? If this will happen or not, we shall see. But I think that is something to remember. For us, we call this principle focused leadership. And focused leadership means for us that we really want to invest in areas where we know we are good at. So that A, we can take out as much executional risk as possible, and on the same end, really also are able within the competitive bidding processes to go to IRR levels that are meaningful. And that obviously can only be if you have ideally a kind of know-how advantage to value a certain opportunity. And then maybe lastly, the 3 things that we're looking at is really synergism, expertise fit, and overall commercial potential. Right? And I think this gives you, I think, a really good flavor, because in the current macro environment that we're in, right, we are, I don't want to say concerned, but we are careful. with making very large investment. And that has multiple reasons. One, of course, is that we are in a hyperinflation environment at the moment. So, big pharma, we have good margins, but I think the pressure is building up. As you all know, right, it's partly impossible to raise drug prices in certain environments and regulated markets. So you have a cap there, and at the same time, you have increasing energy costs and you have increasing raw material cost. That's the cost side. I think on the pricing side, what we'll see, and that is, I think, a phenomenon around the globe, right, that pharma prices are under pressure. Right, we can talk about IRA, and I think there was a panel yesterday around that. Yeah, you can think about European regulation, especially AMNOG getting more, let's say, pushy on certain of these aspects. And then, of course, you have things like VBP in China, so volume-based pricing. China, for us, is the second biggest healthcare market globally after the US. So here you can see that from our perspective, although we have a very large footprint, we are, with own subsidiaries in more than 65 countries on the globe, we are really concerned about what this top-line pressure means at the end. And I think that is something we may explore later in the panel a bit more. The second big trend, of course, that you see, and not many people are, or it's I think, feeding into the almost dilemma that the industry at the moment is in, is that a lot of big pharma players, us not, but a lot of others, they run into a patent cliff towards the end of the decade. And I think there are estimates out there that roughly $130 billion are really at risk. And the question at the moment is how, if at all, can these let's say revenues be replaced? And I think that is a very open question. And that brings you to the last point, which is about that I think there's a lot of sentiment, and I'm reading this since 3 years now, right? And it goes to your question, why is there no more M&A activity? Why is there not more kind of licensing activity? Although valuations of a lot of companies are down, right? XBI, I think, was at its peak or at its most low, 70% down compared to 2020. It's getting back a little bit now, but still, right? There also will be an interesting period within the next 12 to 14 months or 12 to 16 months where I believe a large part of post-Series A companies need to have a refinancing event. So I think here, if you look at the databases, public information, if you look for it, right, especially Q1, Q2 next year will be a really interesting period to observe. Will there be more deals, in my view? I don't think so, because at the end of the day, our shopping list hasn't changed. High-quality assets are typically backed by high-quality investors, and if you look at that investor community, I think they all cashed in very nicely when the market was still at its peak. And we feel that for these high-quality assets, a lot of companies and investors can just sit out the crisis. So arbitrage opportunities, if you wish, may just be limited.
So a lot to unpack there, Matthias, and we'll come to many of those topics during the thing. But let me, I'm a simple person, let me just boil it down to one simple follow-on question for you is, given the current environment, are you more risk-averse or less risk-averse? And what are people out there who have got assets, how do they address that, and what do you expect to see from them that satisfies that risk or mitigates that risk?
Yeah, I honestly think it's, if I may say so, and spice up the panel, it's the wrong question to ask. I think, pharma was always not risk-averse, although there was always this perception in the market, right? I think if you look at us alone, we did 3 platform deals last year, 2 in the TPD space, 1 for a new ADC technology, so where we start literally from zero, no molecule, no nothing, just a preclinical proof of concept for these platforms. So I would not call, I can only speak for our company here, my company, I would not call us risk-averse. I think just that the pressure point is moving away, because take things like IRA, we canceled deals because, we understood what IRA means.
But doesn't that mean more risk, IRA?
No, well, it doesn't mean more risk. It just means, I think, that the way how the industry will develop for the time being, small molecules in the US, to stick with that example, is changing. And it means that the development path itself is more risky, because what do you need to do? You need to go for bigger indications earlier. There is no kind of small molecules US IRA. There is no kind of trying with kind of fast-to-market options anymore, in our view, right? So you have more risk in the program. But it's not that pharma is more risk-averse. And I think that is what you see around the globe, because pricing pressures are coming there. So you need to either because also IRA, to stick with that example, there's still uncertainty what it really means. Will they really use the full kind of spectrum of rebates that they can apply and these kind of things? So there is uncertainty there, but still you need to price it in, and it's not so plannable, I think, in the end, as it was before. And maybe to add one more thing, general oncology example, we all have lived through it in the last years, right? Combination is the new name of the game, or the old name of the game, but it also means that life cycles are shortening, and we see this actually, right? So it's not automatically that you can assume anymore that an oncology drug, especially if it's in combination with an IO agent, you can have your business case rising until the date of patent expiry. That's not the case. It's about niching, and for that, just to give you one interesting point here. We announced our full full financial results 2022 today, and Erbitux, a drug that is off patent for quite a years, reached its all-time high above 1 billion. So I just want to make the point that quality trumps. If there's a high differentiation of assets, and if there's really as much as possible, right, a kind of niching out versus the market, that I think is what many people are looking at, and that is where I think also this rare.
I think we're all agreed on the quality aspect, and Zaki, I'm going to come to you as the other. Can I call you a pharma or a biotech? What do you want to be? I think maybe we'll agree to disagree, because I've been doing this for a while now, and when I came into doing deals, the stock response from big pharma was, come back when you've got clinical POC and show us the data. And I hear that the same thing still today. So I don't know whether we're talking about technical risk or economic risk, that actually it's going to make money, and that pharma's position hasn't changed, and you would say we're not any more or less risk averse than we ever were. Just show us good quality assets and we'll do something, and that will vary. Zaki, do you want to comment on that?
I'll just at least echo what Matthias said, that quality matters, that if you have opportunities that are in the right quality and are sufficiently late, you will see ability and willingness to pay the big money for it. And that could probably explain the figures we saw earlier, that maybe the number increased, but the volume of money spent remains. Also, agreeing to the fact that we are still in my company doing a lot of efforts in the earlier stuff, where we are willing to take risks and long shots. They don't cost us much, but risk willingness is certainly not a problem there. I do think actually probably what we're seeing on those figures are sort of the aftermath effect of the COVID. Again, for the smaller deals, maybe that's the consequence of less activity out there, and people meeting less, and just less exchange of information. Thanks.
Duncan, I'm going to turn to you, because you've been on both sides. You were the other side of it. Now you're a big pharma sort of calling you up and welcoming you with open arms. And what have you got for us?
Yeah, I would say that it's been interesting to see it from the other side, but certainly no lack of interest in outreach and considering deal structures. I think maybe a bit more what I'm sensing, and maybe picking up on some of these themes, is a bit more conservatism in terms of deal structures and whether they're willing to risk more on the front end versus the back end. And typically, obviously, any deal they prefer to be backloaded, but I get a sense there's a bit more conservatism given the economic climate, and also given some of the challenges that different pharma companies, obviously different companies that have their own, be in their different cycles during a strategic refresh, as we heard yesterday, or internal restructuring, reorganization. Some of this in the context of the current macroeconomic climate. So each company will have their own pressures and pushes, and you see that reflected with some of the conversations you get into about what deal structure is going to work, what level of risk appetite they have. Yeah, I think to the point around the different sort of deal volumes, I think it's very different if you have a BD team that have mandated to look for enabling platforms, enabling technologies, and specifically going out to do that, versus team. They would often be very separate to the teams that will be scouting for asset-given opportunities. And that's where I think you can get the disconnect. And the asset-focused teams are going to be more driven by the pressures around the near-term patent cliff and needing to see good quality data and have confidence you can get a launch in a meaningful time frame that will impact the balance sheet to address this patent cliff. And that's where I think there are challenges for companies to have that good quality data, to have unequivocal catalysts in the near term that are going to help understand the value in that opportunity for the pharma company, which will all plug into the business case models that they'll be working at. And fundamentally, those models haven't changed. The risks in development haven't necessarily changed, but potentially, as we're hearing with the IRA, some of the back end has changed.
Right, well, we'll come to back to COVID and IRA momentarily. Paul, I wanted to give you a chance to comment on this. You represent the legal IP side of this, and clearly you must sit on both sides of the deals. Have you seen any changes in that need to be captured on the contractual side to deal with risk or not risk, or is it business as usual and same as ever?
No, I wouldn't say that. But to come back first to the fundamental trends, what was clearly striking, and you mentioned it, is the contrast between a reduction in deal numbers and the increase or maintenance of volumes, except for your bonus slide, where venture capital, even the value decreased. And I think that's clearly is the picture we are seeing today. It's more strategy-driven transactions. It's more selective, certainly. And therefore, our job is to adapt. And we haven't perhaps seen yet enough moving away from templates to refocus on what makes a difference between a pure investment and a strategy-driven transactions. You need to spend more time thinking about what the assets are. You need to think about what the proper milestones are, what the earn-out or royalties parameters are, to match your strategy, to match your objectives. And I think there's still more to do in that respect. In terms of mitigating risk, because risks are there, we shouldn't hide it. And even if values are maintained, the fact that deals are reducing. Let me make a parenthesis. I just read a survey which came out, I think, not even a month ago, and which supports what you said as well. It looked at the transaction during the financial crisis in 2007, 2008, which also was a period where we almost only saw strategy-driven transactions. And 10 years after, they were outperforming all the other transactions of the years before and the years after. So go ahead. It's the right time. You're right to do what you're doing. Don't know whether you want me to mention it now, but of course my job is to mitigate risks. So my time I spend trying to find solutions, innovations, new ideas in transaction drafting to make sure that you mitigate as much as you can the risk, starting with due diligence, but I think you are well equipped to do so. But even on the legal side, you can do more. And in providing, when you enter into a transaction, you do it in respect of the partner you want to do something with. But that shouldn't prevent you from thinking about alternatives. We've seen it with supply chains. The idea of I'm going to count on that partner for supply chain without thinking about alternatives has proven a nightmare in quite a few circumstances. Considering the possibility that the technology would not work and agreeing on alternative technologies together. That's also something you can do to mitigate risks. We've gone through the period of COVID, high inflation and so on. Just redefining force majeure, redefining MAC clauses, just redefining best efforts can make a big difference. That's it. That's a few ideas. Those are a few ideas to mitigate risks.
Yeah, Matthias, please.
Can I just add something to it? Fully agree. And I think also something that I expect we will see more, and actually we do see it more, is really risk-sharing transactions. So think about partnerships. Yeah? I think you didn't show the split, but at least the data I'm looking at, if you look at the total deal numbers and split them up, yeah, you see much more partnership transactions. I think that risk sharing is also something, financial risk sharing, yeah, development for also sharing, of course, some upside at the end. That is something that is, at least in my view, here to stay. Because from a head dependency standpoint, I think having more, and that is what we are propagating really, more ecosystem-based approach. Yeah? is the right thing to do. Because if you look at many pharmas and many biotechs, I think the boundary between being a developer, being an investor, and being a kind of licensee, licensor, that gets much and more blurry these days.
Right. Well, and we anticipated more sort of collaborative deals, and again, we'll talk about deal structures. That just pushed things more towards option-based deals as well. But collaborations and risk sharing tends, I think, to push things towards earlier stage deal making. So because there is more risk, and you're mitigating the risk, and you're still doing the deals, which is fine. But is there a tension there between that desire and investors who are investing under traditional models still, where they expect to see it get from A to B and B to pharma, and they're not factoring in funding of collaboration deals where it's A to B, B and C work together, and then ultimately it goes to pharma. So there's a gap there. Do you see that in some of the companies that come and talk to you and offer their assets to you? I don't know, Matthias or Zaki or even Duncan.
I think the answer is yes, actually, to it. I mean, if you look at what's happening, I mean, the number of kind of unsolicited proposals that reached us since 2 years is at least 3x higher than it was ever before. Right? And I think one piece of it is that some companies, they realize that because you have the kind of, dry funding environment still at the moment, and I believe it's here to stay until we've really reached peak central bank interest rates. And, if you look at historic data, that can still be only the case in 2025 in conservative estimates. Yeah. So you have companies that really look for non-dilutive funding, and I think that's one of the drivers here, right? Because they realize that, given the risk profile of the asset, given maybe also the attractiveness of the asset, right? It's very difficult to attract, let's say, new public funding and or new private funding, and therefore they come to us. To put this to the extreme, I think what we have never seen before, prior to really, let's say, the inflation environment picking up, is that even lead assets of companies, small companies, are maybe for sale completely or open for partnering, right? And that is, of course, I think linked a little bit to a sentiment in the investor community, and unfortunately we have no one here on the panel, but I think there are some people in the audience, so happy to have that discussion, where we see that even in boardrooms there's not always the same opinion. There are some investors that stand truly behind their biotech investments, and it's very difficult kind of to convince them maybe to carve out an asset there. But you see also that a lot of people want to get out actually of certain investments, so that they can utilize literally the market momentum that is there at the moment to reinvest into new opportunities that come at a very attractive, let's say, valuation. And I think that's a little bit the tension field that we're observing, to your point.
Yeah, and I think this is where it's interesting to think, with a pharma company offering a collaborative shared risk approach, it sounds great, but it's great if you're funded to do everything else that you want to do as a small biotech company. And when you do have pressures from investors, and I think the investors at the moment are under pressure to offer returns to LPs, a shared risk collaboration doesn't really help move the needle there. So this is where I think there are companies that are then having to relook at their portfolio, understand what could help them monetize, be it in a shared risk or a licensing deal, and what form the portfolio needs to look like beyond that for the company to continue. But I think the shared risk principle is nice, but it doesn't necessarily solve all the problems that companies are particularly going under in the current funding climate.
So is that what companies will need to do? And we heard yesterday, again, I think it was on one of the investment panels, that companies maybe need to think about a flat or slightly down round to survive, and do that, and then understandably, if you're going to trim your portfolio, you're going to look less valuable than you did on the previous round. Obviously, that leads to then it being cheaper for the farmers. But if you're a pharma and you're looking and you're accepting that there are going to be these collaborative deals, what are you expecting people to show you to say this is, and do you want them to come and say, I don't want you to license it, I want you to collaborate with me, because I want to get to A to B? Should they be coming with that story, or should they just be coming with a traditional, here's my wonderful asset, I'm going to have proof of concept data in X months' time, and please license it? Do you have a preference, or do you just say, just bring us your stuff and tell us your best story? Zaki, do you want to go on that one?
Just bring the stuff and we will figure it out. That will be the initial response. I think maybe also the risk sharing and the backloaded deals come from the expectations for higher upfronts. So basically, if there's a huge chunk in upfront, then we would expect some level of risk sharing for the later stage. So it needs to make sense on the financial side, and it doesn't always.
And just on that financial side, and again, we're jumping about a little bit here, there was the panel on the Inflation Reduction Act, and that most of the things that are coming to your attention now are going to be impacted by that. And should biotechs, when they're building their story for you, factor that into their valuations, or are you going to do it for them and tell them your numbers are crazy because IRA is going to impact you and you're not going to make as much money as you think you are, and that's going to, or are you going to put deal terms in that have high royalties that are probably never going to be achieved, or high milestones that are never going to be achieved, but the deal still looks like it ever did? Here's a deal for $2 billion, but they'll never get there. What's going to happen?
We haven't seen anybody factor them in yet, but of course we would do that on our end.
Is that a Eurocentric thing? Because I think one of the panelists yesterday in the IRA thing said, we're still doing POC, that's what matters to us, we haven't thought about this yet, and that was an investor. Right. So is Europe still looking at it? That's happening over there. I know that's the biggest market, but we don't have to worry about that yet, and we'll panic later, or not, or are we really starting to think about it? And should biotechs, when they're building and when they're going for their investment, when they're doing, really be factoring that into what the future value of their businesses are or their assets are? What do people think?
Yeah, I mean, look, the answer to it is yes. Yeah, and let's very quickly review in 10 seconds what the IRA is about. The IRA has three elements. One is the inflation penalty, so you are not allowed to raise drug prices over the actual inflation anymore. It is what it is. Yeah? The second thing is, of course, the price cuts, and I think that is what everybody talks about. So small molecules 9 years post-launch and large molecules 13 years post-launch. Yeah? That is, I think, partly a problem. We talked already about kind of shortened life cycles. Yeah? Because one thing how you could see it is that at the end, let's say the treaty almost, right, between the biotech and pharma industry and the society to say you get a monopoly, the patent, yeah, that you can exploit for a while, is kind of undermined by this. So that is something one needs to talk about, right? And I think the third piece is, and that is what we always find not many people factor into their business cases, is that the copay in the US goes up from 4 to 20%. Yeah, so what this means is that for a small molecule, you immediately lose 16 base points profitability, full stop. Yeah, and that is, of course, something that you need to factor into deal terms, right? It is more an easy discussion I want to have for later stage assets, because here you talk much more P&L. At the end, you line the P&L views, you line top line, you line, whatever is the line item you look at, and at the end also profitability, and there you can have a very factual discussion with a partner, we find. Still, it doesn't necessarily mean that everybody has the same view on all these lines, but, the basic law is the law that has been put into force in the US. Yeah? It becomes a bit more tricky than on the, let's say, pre-POC side, where business cases, let's say, have a higher flexibility because you don't have a clinical proof of concept yet. So there are different, let's say, optionalities still on the table, but still here, right? You also, and we talked a little bit about it, I made that comment, since the development approach needs to change, because there's no time for life cycle management of small molecules that fall under IRA. Yeah, you need to partly discard also completely, value that cannot be harvested in the market as it was pre-IRA.
I mean, just to sort of comment from the biotech side, it's certainly something that we're factoring into how we look at our portfolio. I think there's an impact on clinical development strategies, which indications you go into, and in which regions, which territories you develop first before going into the US. So our lead program in fibrosis is currently being explored in IPF, and obviously there will be an impact if we go beyond IPF. There's other indications we could also go into. And I think if you look at areas like oncology, you see sort of biologics and ADCs coming through, and how a small molecule is going to compete. A lot of pharma companies are coming out and saying that their strategy is now to go beyond blockbusters to the multi-billion blockbusters and focus on those. And how easy is that going to be with a small molecule program? And all the life cycle management strategies Matthias was just talking about, how is that going to work? Is that going to be as easy? How will that compete? So I think it's certainly impacting how we look at our development, which indications, whether we have backup series, whether we have other molecules and related series that we develop separately in these other indications rather than the one molecule in multiple indications. These are all considerations we're taking on.
So if ultimately new drugs are going to be worth less in the marketplace because they're not going to attract as much revenue because they can't, because of restrictions being placed on them, but they're going to cost as much to get them there as they ever did, if not more. The amount of money that investors are going to have to put in is going to be more. They're going to want more of the company. So should those founders and biotech inventors expect to do much less well than they have, the can is going to get kicked down and they're going to have to carry it. Is that what's going to happen? What do people think? Or are we going to have quality, as we said earlier, quality will win out the day, and we'll just see fewer assets, but they'll be higher quality, and everybody will do as well as they ever did? Anybody care to comment? Whose fault is it, I'm asking?
It's difficult to forecast, of course. That could be one consequence. Another consequence could be more selectivity, and therefore that indeed things fall away quicker. But I wanted to say two things. One, don't think it's only in the United States, because this is a topic of discussion in Europe, in China, in quite a few other markets. So don't believe that because it's called IRA, it's not going to be an issue of discussion in a European transaction or Asian transaction. It's going to happen. It's actually already happening. We have discussions about levels of reimbursement, the role of insurance companies or private insurance and so on. That's going to be playing a role again. To be more optimistic, unfortunately not yet in life sciences as much as in other sectors, another consequence of IRA in the United States or similar initiatives in Europe is that you will have more subsidies as well. So that's hopefully going to play a positive role, because it's going to reduce the amount of money needed by investors or buyers. So there might be a new balance to find, but I'm hopeful that a new balance will be possible.
Okay, I'm conscious that we're running out of time, and there was a whole list of things that I said we'd come back to that we haven't got anywhere near. So let's just switch a little bit. What are the hot areas, both from what investors might be investing into, what pharma is looking for? Is it cell and gene? Oncology is as big as it ever was. Are there particular therapeutic areas that are in vogue or not in vogue, or modalities? Is it cell and gene therapy? Is it AI? We get a lot of people coming through us and going, yeah, I'm an AI, this company, and one of my first questions is, are you really AI, or have you just got an algorithm? Because it's like immuno-oncology. Everybody called themselves immuno-oncology because it got them an audience with these guys, and then they went, no, you're not really. So what's hot? What are the areas you guys are looking for, and what do you think people should be focusing on? Who wants to go first? Paul, you're going to say, I'm sorry, Duncan, you're going to say it's exactly what Redx are doing. So that's the hottest area in town right now.
Well, that would be oncology and fibrosis. But I think there's certainly interest on the rare disease side. I think understanding opportunities in that space, potentially where they cut across multiple rare disease indications, IRA issues notwithstanding, I think that is of growing interest on the pharma side. I think we've seen some interesting data coming out in neuroscience, in Alzheimer's, that maybe help give some credence to specific mechanisms that can show activity, and it'd be interesting to see how that develops over the next few years as well.
Yeah, I mean, I still remember ASCO last year, right, which was very depressing, at least for me personally, feeling. I mean, yes, of course, Daiichi and HER2, great data, really breakthrough, but then it went, I think, at least in, through the lenses how we see oncology, it went very quiet very quickly. Yeah? And I think that is what we see at the moment throughout oncology. I mean, we're fully committed to oncology, don't get me wrong, but I think in terms of innovation hype cycle, it feels that we're rather at a lowish area at the moment, right? If you look at the number of post-Series A companies, right, they are at the moment, roughly speaking, twice as much out there as the historic average was. So this could speak, or you could interpret this towards a certain overinvestment into that area. What we also feel is that neurology and immunology is really the next, let's say, battleground for precision medicine, so that a lot of the learnings that we see also that the investments are picking up in that area that we had in oncology are being transferred to that area, while we at the end also decided that, and we also told the capital markets community that already last year, that we want really to actively invest into neuroinflammation, because we feel that that is something, think about back what I said initially, focus leadership principles, where with a neurology franchise and an immunology franchise, we're really very much set up to do, and that is something where we will do more. We acquired already a first company last year called Therapeutics to really develop cladribine, or a formulation of cladribine in these indications, also public information. But yeah, this is an area that is of interest for us.
Okay. We're running short on time, so I'm going to throw it open to the audience to see if there's any questions. Anybody got any burning questions for our panelists? They are all... Oh, there's one. I thought we'd answer them all.
Hi, good morning. My name is Dima from Forbion, a life science VC. I have a question about IRA and taking consequences for both for you guys and for us investors. I'm hearing that some parties are taking consequences, some parties do not yet. Just maybe a direct question to the pharma companies. Maybe I have a wrong thought here, but looking at the list from 2021 at the top selling products, you need to be in the range of 5 to 20 billion sales to end up on this list. So how many of those products do you have in the pipeline, and how many of those products do you see from biotech companies coming out? So is that a luxury problem to have?
What's your pipeline like, guys? That's the question. Full of big, healthy things.
It's full of good stuff, but I can promise you it's not full of assets that gonna go to that range of turnover. That's for sure. And I'm seriously, so I'm in search and evaluation, and the dictation I'm getting from management is to go out and find the really, really big ones. But I mean, it's obvious to everybody that there are very, very few of them. So it's a hard battle to fight. Matthias, do you want to add?
Yeah, I give you a data point. The budget that was associated, or that was given to the team that is implementing IRA is $3 billion with, I believe, 45 headcounts. What this tells you, I think, is that this is just the beginning that we're seeing. And that is, it's not the concern what's the first tranche of kind of products that fall under IRA. But at the end of the day, you don't need to have 45 transactors and a $3 billion budget to take care of 5 drugs. Yeah, so I think that we will see a very systematic approach, and of course they will go down the list further and further. And this list, of course, that's a bit the uncertainty. This list refreshes itself all the time because also you have new launches, new products coming in, life cycles, are coming to an end. So there is a dynamic in there, right? But I think you're right in your assumption that drugs that potentially fall under, let's say, the IRA regulations, but don't make it to the top, yeah, they are the good ones from that perspective. So if you think rare orphan indications, yeah, although we always traditionally, I think as a whole industry, investors and biotech pharma, so developers, yeah, struggled because in kind of investment costs are roughly the same, regardless if it's a $2 billion or a $500 million drug, yeah. But maybe these ones are also not too bad bets for the future because you are protected more than with the big ones.
I will be just curious to see, because, I mean, we have some certainty around the time, right? It's 2029, we will have top 20 products in Part B and Part D. So that is some certainty there. So you can count now 9 years on top, it's 2038. So by that time, we have some certainty what drugs will be on the list. I mean, how much ahead can we plan? 2038, that's quite far out, I would say. So I see just some panic that is not really justified in terms of, now not making investments in small molecules anymore, or even stopping development as it was announced by some companies. That's my concern, to maybe not panic now, but Adrian, as you said, let's panic later.
Yeah. Okay, I think we're out of time. I was going to ask, we seem to have been a bit negative on this. They say the night is darkest before the dawn. The dawn is coming, I think. Things will get better. I was going to ask them all to say something positive at the end, but we run out of time, so apologies for that. Please, can we thank our panellists for their excellent insights, and thank you all for your attention on this panel this morning. Thank you.